I'm speaking with Susan Kasser, co-head of private credit and portfolio manager private debt at Neuberger Berman. Susan, what's the biggest red flag when assessing an investment?
The biggest red flag is absence of sufficient margin for error. So I do think a lot of people have the temptation to price or leverage an investment to perfection. Instead, you have to price or leverage an investment to the complicated and unpredictable world that we all have to live with.
What's the most important benefit of private credit?
The most important benefit of private credit is that the return is generated almost entirely by cash coupon that is contractual and paid quarterly. If you think about the performance in the pandemic and the economic shutdown, fully 99% of our portfolio was paying its coupons in cash, in full, and quarterly to our investors, which was really important to them in a difficult and volatile time. And I would like to point out that by 2021, that 99% was back to 100%.
Which asset class has the best outlook for returns over the next 5 years? Credit, equities, or bond?
Okay, 5 years is a long time for somebody like me, so I'm going to stick with, let's say, 18 to 36 months. If I think about the public asset classes, credit or equity, they're likely going to be affected by volatility in the near to intermediate term. If I think about bonds, they will probably be adversely affected by rising rates in the near to intermediate term. On the other hand, if I think about private credit, the coupon is what generates the return as opposed to price appreciation, so you don't have to worry about volatility or valuations. The coupon is floating rate, so in an environment like today, investors actually benefit. And perhaps most importantly, if people are worried about the economic outlook, private credit is senior secured, top of the capital stack, so the safest place to be, lowest probability of loss.
What's the most important criterion when assessing a borrower?
There are so many, and I will list them, but I think probably the most important criteria is don't talk yourself out of ignoring any one negative signal. So some people will look at a long list, and if some are good, some are bad, they'll still proceed. We think the most important thing is if you see any negative signal, don't proceed. And very quickly, here's a couple of those signals. What industry is the company operating in? Is it growing? And is it recession resilient? Is the company market leading? And does the product or service that it provides truly necessary? What is the quantum of debt on the company? And can the company handle its interest expense and other fixed charges in a reasonable range of downside cases? If you're wrong about all of this, what strategic acquirer could you sell this company to at what price if you had to restructure it and own it? And last but not least, the private equity fund that is buying the company, are they qualified and experienced in that strategy? And do they have a consistent track record of treating creditors with respect, even in a downside case?
Which period was the most difficult for private credit? Was it the pandemic or the interest rate hiking cycle?
Oh, both difficult, very different. So the pandemic benefited some parts of the economy, but hurt other parts of the economy. The parts of the economy that were affected very sharply, but in some cases for a short period of time, in other cases for a longer period of time. And we benefited from unprecedented fiscal and monetary support. If I look at the hiking cycle, it's affecting a much wider range of industries and companies, less dramatically, but probably for longer. So in either case, the most important thing is to stick to your underwriting discipline. Look at industries that are growing and recession resilient, companies that are market leading and have a reason to exist, and make sure there isn't too much debt on these companies.
What do you consider to be most important? Cash flow, leverage, or profit?
I love that question. It's funny though, because they're all linked to each other. So you can't have cash flow without starting with profit. So we look for companies with high profitability. In our portfolio, the average EBITDA margin is 25%. Then you take out interest expense, working capital, capital expenditure. That's how you get to free cash flow. Free cash flow is really important because that's what you're going to use to service interest expense. We look for companies that have very significant free cash flow to interest expense. The average in our portfolio today is 2.5 times. Then you have to look for companies that aren't using a ton of free cash flow on things like working capital and CapEx. So we do prefer services and software-oriented companies. But there is one more metric that wasn't in your question that's important to outline, and that's equity cushion. So how much value of the company is there under your debt? On average, we have about 60% equity cushion under our loan.